Hi, everybody. This is Gary Dean, and this is our weekend video report for Sunday, March 5th, 2017. Hope you guys are having a fantastic weekend, and let's get started. So, Friday, we saw a little bit of both sides working in the early trading. We saw some selling that was continued from Thursday's mini sell-off, and from there, we saw our short-term charts that were kind of giving us some buy signals, and the futures were the same way. So I kind of was saying I would, it was open-ended for to find some kind of support and a bounce on Friday in the morning notes, and that's pretty much what we got. But the dynamics are changing with this rally, and we can see it. The market's really, really tired. People are going to have to start seeing, before this, they just continue to scream higher. I think some of the things that are out there that are really pushing this market higher, so the tax cuts, the corporate tax rate, Obamacare, all that stuff. I think we're going to have to start seeing some of that actually come into play before they start really charging things higher, because just from a fundamental view, we are really, really kind of overextended with just going off of PE ratios and stuff like that. But I'm not going to get into it because that's really has nothing to do with what we do. We're just looking off of a technical basis. I'm still anticipating that we are going to get a large drop that's going to shock some people. Did we top? Possibly. There's, some reasons to say that we could expect another high, but it's on borrowed time, and I think that even if we do make some kind of new high in next week or something, that it's going to be one of those situations that it crawls up, maybe makes a new high by 2, 3, 5 points, 10 points, whatever was on there, and from there just gives it right back again. And this is all part of the topping process. It's frustrating. It a lot of times it morphs into its own little world, and the melt up that started in February, like I said, that was not really expected on my end, and it caught me by surprise. But now, you brush yourself off. Nothing's really changed as far as the overall picture, and now you just, start to look for clues as far as, when things are going to top and where they're going to top. And, I'm not saying I'm looking to catch the exact top. We're just really looking for the topping process to show itself and then get some kind of confirmation. So Friday we have the S&P closed up a point, I think a point 20 or something like that. But as you can see here on the money flow chart, that the S&P was getting absolutely crushed again. So even as we were rallying and the S&P only closed up a point, it was in the number one spot as far as selling, with block trades as well as money flow. So red flag. That's again, it's not one of those say charts or indicators that says things have to turn right now. But what it's showing us is that when we're getting these bounces, the institutions are selling them. And I know I read someplace that a lot of the buying that's been going on has been through retail. I mean, I don't know really all of that, but it would make sense just from looking at the past few weeks where we're getting these big moves, and we're seeing that institutions are selling. So things are changing. When they do change and things are confirmed, most likely people are going to be too long this market, and they're not going to be short. There's not going to be enough people that are short the market. And one of the reasons why that happens, I'm just going to show you the regular charts, is every time we've had these little pullbacks, it's been bid back up. So the thing is that why would anybody doubt that these dips are going to not going to get bid back up? So as we drop, people are going to continue to buy, and then what happens is they get a little bounce and we don't make new highs, and then comes back down. And from there, people get a little nervous, but they bounce it, and then out of the blue, we get one of these moves that just goes straight down, and it catches everybody by surprise. So I'm going to go back to our to these charts, and so we have a lot of selling going on with institutions. Now let's just go to some of these charts that I follow for, say, the internals of things. And One of the things that I point out is that when the VIX is down here and we have massive divergences, this is not the time that you want to be buying. Yes, we can go up and it can do it, but what you are risking is getting long and staying long a big drop that's going to be pending. And we've seen that a lot every time it's been down here. And the longer it drags out, the harder to fall. And this one is one of the longest that we've seen. I mean, this was some chopping here, so it was longer, but you can see that we have the huge bullish divergences, and the VIX is at levels that you do not want to be buying the S&P, even if it does head higher, because it's just not really a safe area. So if we just take a look, and this is just a wave count that's sometimes easier to show on this chart, but this is a weekly chart. And again, what I'm looking for and the way I have this labeled, and like I've said, I'm not a huge Elliott wave, say, counter and stuff like that, but I'd like to just take an overall view to anticipate when it does break where support could be. So here we can see we have one, two, now we're making this wave three where we have one, two, three, four, and we're making this, it's obviously an extended wave five. But once this completes, this is our wave three, and from there, we should get a pullback that is going to come down someplace between the let's say the 2000, we'll say 2100, all the way down to to the 1800. And the reason why is this wave four a lot of times matches up with this wave four. So we have the 200-day moving average. So let's say it doesn't get all the way down there. We're still, this would be the area that we're looking, someplace in the say 1964, somewhere in that area. But this is the move. So if we do get down here, it's we're talking almost a 400 point drop. So that's where I'm saying I'm not looking at this as a start of a new bear market. I'm looking at this as forming into like an ABC, and most likely it's going to make an ABC of an ABC, because there should be two of them that comes down. But once that completes, we are going to get a wave five that's going to take out these highs, and we'll probably see the S&P trading somewhere up at 3,000. But a lot of people won't really be believing that's coming, because we haven't seen a 15 or 20% correction in a very, very long time. So once we get that drop, most people are going to be thinking that we're starting a new bear market, and everyone's going to be piling on the short side, and that's going to be the fuel to start the wave five. So that's the bigger picture, and that's where I could see this drop going. And again, the trade that I'm in right now, I'm not expecting it to come down to these levels right now. I'm looking for probably coming into this support area at the 2100. This is if I'm short and we're there, I'm going to probably be taking some off at the 50-week moving average, and then some off at the 21. But again, we have to wait for this market to top first, and maybe it did, but I'm not willing to stick my head out and say that it definitely did. So this is just a shorter term chart of the S&P, a 60-minute chart, and here you can see this is where we're looking for this wave five to end, and it's extended, and it would have made sense right here where I originally had it, and this part just kind of took me by surprise on it that it extended so high. But this is where it's at, and you can just see all these gaps underneath it. And I've explained, when you build rallies like this with so many gaps underneath, it's you're building a skyscraper with on a foundation of toothpicks, because once one of the level starts going, they all crumble, and a lot of times you see this entire move taken out in days, and I'm not really wouldn't be shocked to see something like that take place. So if we just look at our regular charts again, this is a regression channel. We are very, very overextended on it. I actually drew another one that takes me back even further, and you can see we're at the top of that range as well. So this is giving red flags as far as just getting very, very complacent. But if we notice, we don't have bearish divergences. So if we get that move that comes down someplace into this area, it's going to be setting up the next move up, and that's where we'll probably be seeing some bearish divergences on the longer term charts. But again, I'm not really too interested in all that. So I already showed you on the 60-minute chart that we're just really waiting for this wave five to end. When it does, I think you can see the buyer stepped in right around that 23.74, which was the 50-day moving average on a 60-minute chart. So if they take that out, I've been saying this is where the bears need to push through. If they do that, then we're probably going to get a panic sell-off down to this 23.27 area, and then we'll get a bounce. And if they use the 50-day moving average as resistance, then they come down, and if they start taking out these levels, that's when we're going to really start to see some panic set in. And like I've said, I wouldn't be surprised to see this entire thing taken out in a matter of 3 to 5 days. It's just a matter of timing. When the big drop starts, and like I said, maybe this is the top. Maybe they come up and make it a minor new top. And my reasoning for that is we don't have bearish divergences on the 60-minute chart, and we have not really seen any meaningful drops take place unless we see bearish divergences. So that's leaving the door open for a test up and possibly breaking this 2402. But also what I explained was that, being we have so many sets of these bearish divergences, maybe they're not going to come up. So it wouldn't be something that I'd be making huge trades on just because it's not there, because we already have, so many different sets of them. So again, the bears need to get it through this, the moving average and this support right here, right around that 23.73. If they lose that, we're probably going to get a very, very quick sell-off down to the 33.27. From there, I'm expecting to see some buyers step in. 15-minute chart looks like an ABC. So if that is the case, then the longer term, this is still here. But what it would be is that we'd be maybe putting this here and saying, okay, now they're going to make the final push up. Not 100% sure that they're going to do it. And on top of that, they still didn't even get down to the 23% retracement. So typically they come down to these levels before actually heading up and making a wave 5. But like I've said, this is so extended, I wouldn't really be banking that much or putting too much money on any kind of bounce, because this can turn at any time, and that's really the main point that I want to get through. So the 2370, again, this is the support area that the bears need to push through. Bulls need to get it above the 2390. If they do that, then most likely we're coming up and testing the 2400. Just on a 5-minute chart, we can see that we had some bullish divergences, so we did get the bounce off of that. We never closed this gap, so it's still another gap that's open. At the resistance area, anywhere between that 2388 and the 2390. If they do that, then they're going to probably come and close the gap at this 2395. Or, like I've been saying, take it above the 2401 area, just to to start those bearish divergences. So tomorrow, I'm open-ended on what's going to take place. Like I said, we're seeing some selling from institutions, so you don't want to get too complacent. There's reasons to expect a slight break of these highs, but for as extended as we are, it wouldn't surprise me if we head down. So the bears need to get it through this 2375. Bulls need to get it through this 2390. And from there, enjoy the Westview weekend, and I will talk to you guys tomorrow.